Hello friends, welcome back to the next video on basic accounting concepts. So in the previous video we have covered 3 concepts and we have also seen what is an accounting concept. So come without any further ado, let us move into the next accounting concepts. So in this video we'll be covering 5 accounting concepts. So the fourth one basically would be accounting period concept. So it states that the financial reports are usually prepared in fixed or equal intervals. That is usually, as all of us know, it is 1 year, but a firm, according to its comfortability, can prepare the financial statements during the mid of the year, that is once in every quarter, that is once in every 4 months, that is sorry and 3 months, or 6 months, or 1 year. So when a firm prepares the financial statements in between the year, it is called as interim financial statements. This is mainly required because obviously the Income Tax Act and the Companies Act demand yearly reports. So it is must for every company to prepare the yearly financial statements. The interim financial statements are up to the firm whether they have to prepare or not. But the accounting period states that there should be a fixed and equal interval in preparing these financial statements. The next concept would be cost concept. So cost concept, also known as the historical cost concept, here there are two main things to be noted. All the items are recorded at the price they are acquired. When we say that all items, here it particularly refers to all assets. All appreciating assets are acquired at a particular price and they are recorded throughout their existence in the business in that purchase price only. At the same time, what is this purchase price? This purchase price will include the cost of that particular asset. If there is any installation charges incurred, that will also be added to it. Furthermore, the carriage, the labor charges for bringing the machine from the supplier's place to our place, etc., all the expenses incurred at the time of sales or at the time of purchase will be included in this purchase price. And also at the same time, this is the case for purchase price or the recording of assets which appreciate. If there are any assets which would depreciate in value, that is like machinery will have depreciation, whereas land will not depreciate, it will only appreciate and the value will only keep on increasing. For assets like machinery, plant, etc., the value is recorded only after depreciation, whereas appreciating assets are recorded at the price they are acquired. So let us see in detail. When you purchase a machine, for example, if the cost of the machine is 1 lakh and you incur several other expenses, that is installation charges rupees 10,000, labor wage to install is rupees 1,000 and carriage fee is 5,000. So in the total cost of the machine in your books of accounts would be rupees 1,16,000, not just 1 lakh just because the cost of machine is only 1 lakh. No, the other expenses incurred because of the machine will also be accounted that it is the cost of machine only. So the total cost of the machine in the books will be rupees 1,16,000. This is what we mean when we say all assets are recorded at the purchase price. Here, the next example would be recording the appreciating assets in the purchase price and not in the market value. So we know what is purchase price. That is the price when we pay when we acquire an asset. So what is this market value? The market value is nothing but the current value of that particular asset. On that particular date, if you sell that asset, what amount would you get in the market? That is called as the market value. Here, if you buy a piece of land for 1 lakh, definitely after 2 years, the value of the land would appreciate at least by some percentage. Here we take it as 3 lakhs, just for example. if it has appreciated to 3 lakhs. But in the balance sheet, you record it only as 1 lakh because this 3 lakh is only the market value, whereas 1 lakh is only the value in which you purchased. So we record only the we record only the purchase price of assets and not the current or market value of the assets. So the next concept would be dual aspect concept. When we say dual, it means two. So every transaction in accounts will affect at least two accounts, okay? Now all transactions are recorded in both the accounts affected. Say if you say it is a cash sales, it will affect cash account as well as sales account. That is, you are receiving cash and you are selling goods. So it will affect two accounts, two places. Minimum it will affect two accounts. So here cash is like you are receiving cash. So it is a debit. According to the golden rule, debit what comes in. Cash is coming in. So you debit, and according to the real account golden rule, you credit what goes out. So you have to credit sales. So here, as you can see, every debit has a corresponding credit. A debit of cash has a credit of sales. So here, let us take another example wherein credit sales of goods worth rupees 2500 to Mr. Akash. So the accounts affected here are sales account and Akash account because he is a debtor for our firm. So sales is on the credit side and Akash account lies on the debit side because he is like an asset. So he is a debtor for us. Our money is with him, that is our goods is with him, and he has to give us money. So it is like he has not paid back the money which belongs to us. So it is an asset for us. So this obviously paves the way for double entry system of accounting, wherein every transaction affects at least two accounts and it is recorded in both the accounts affected by the transaction. So now let us move on to the seventh concept, which is called as revenue recognition concept. Revenue is nothing but all gross income, that is the net inflow of cash into your business from sales and other activities. The other activities could be dividend received, commission received, interest received, etc. So here the revenue is recorded when it is due to be received. Whenever you are supposed to receive that revenue, you record it. But based on the time received, its treatment differs. To be more specific, let us see in detail with an example. For example, you have gave a portion of your factory for rent and you are supposed to receive rupees 2000 every month. And the rent to be received for the month of February is 2000. In the month of February, it will be recorded as a revenue because it is due. Also, it will be recorded when it is received as well because you realize the revenue. Let us see in detail. The three different treatments possible are, for example, instead of paying in the month of February, the rent is paid to you in the month of January itself. So, it is an income which is supposed to be received in February, but you have received it in January itself. So, it is like income received in advance. You record it in the month of January because you have received income. You have to show it in the books of accounts. At the same time, you record it in the month of February also, saying as rent due for this month. You may have a doubt now that we are recording it twice. No, we are not recording it twice. That is in the month of January when you record this rent, you will just say cash account debtor to income received in advance, that is rent received in advance. You will not give the name for that cash as rent received. Instead, you will say rent received in advance. In the month of February, what you will do is just like changing that name into rent received in advance to rent received. So in order to cancel this transaction, what should you do? You have one credit in that account. So go to the debit side. On the debit side, you will write rent received in advance account to rent received. So this is quite a very tricky concept. Here, as of now, I think it would be fine and easy if you understand the three types of treatments, and in detail you all will be learning definitely in the financial statements chapter, wherein we will cover a separate topic on adjustments. So in that particular topic, we'll be clearing all the doubts all we have now. So as of now, let us say if you receive it in January, it is like income received in advance. There is no problem if you receive it in February, because it is due in February and you have received it in February. So it is just income received. But the case is, if you do not receive it in February, it is called income outstanding or outstanding rent, because you're supposed to receive but you have not received. The word outstanding means not received. So these are the three possible treatments in a revenue. Either it could be received in advance, it could be received on time, or it could not be received. That is, it could be outstanding. A revenue could be of these three possible types. The detailed accounting treatment and how will it tally in the books of accounts will be dealt separately when we study the chapter financial statements and their adjustments. So the next and the last concept in this video would be matching concept. Matching concept is nothing but, as the name suggests, you have to match the expenses and revenue. That is, all expenses and revenue in one accounting period should be matched to each other. Cost of goods sold should be considered and not cost of production, so that the revenue earned on sales could be matched. So to understand this particular statement, let us see an example. We have produced 1000 shirts at the rate of rupees 100 each. Okay, we have produced 1000 shirts at the rate of rupees 100 each, and at the same time the expenses incurred would be 100 into 1000, which is 1 lakh. And you have sold only 950 shirts. That is, you have sold 950 shirts at the rate of rupees 150 with profit margin, and you receive rupees 1,42,500 respectively. Now, you can't say that I incurred 1 lakh and I received 1,42,500, because 1 lakh was the expense incurred on 1000 shirts, whereas you sold only 950 shirts and you received 1,42,500. So what you do is, the revenue is for 950 shirts, so the expense should also be for 950 shirts only. The expense incurred would be 950 into 100, which is rupees 95,000 would be your expenses incurred on that particular set of shirts which you have sold. So this transaction wherein 950 shirts have been sold, so that is the goods sold. The cost of producing that 950 shirts is called cost of producing the goods sold. The cost of producing the goods sold is rupees 95,000, and you have received in return as revenue rupees 1,42,500. So now the expense and revenue is matched. Previously, you had recorded the expense for 1000 shirts and revenue for 950 shirts. It is not matching. See, if you cook for 10 people, 10 people should eat. You can't say that I cooked for 10 people and 20 people will eat, or I cooked for 10 people and only 5 people are eating. No, it is not matched. So, and you can't say that I cooked for 10 people, only 5 people ate, 5 people's portion of food is leftover, it is a waste. No, only if you have cooked for 5 people, you compare and say I cooked for 5 people, but in spite of that I have got so much of leftover, so I have not cooked properly. But if you cook for 10 people and you serve only 5 and you say no, there's so much is left out, it's not easy to compare, and it's not logical too. You have produced 1000 shirts but you have sold only 950. So what you should do is, you should take the expense incurred on those 950 shirts and then compare the revenue earned. So this is called the matching concept. So with this we come to the end of this video. Here we have seen the next 5 accounting concepts. Hope those 5 were clear. If there are any doubts, please let us know through comments. And stay tuned to Intellify to know more about the upcoming accounting concepts. Hope it was easy to understand and clear. So till we meet again in the next video, this is Sangeeta Selvan. Thank you.